Imagine a massive, sprawling metropolis. Millions of people are buying groceries, paying rent, settling these massive corporate contracts, and, well, sending money across borders.
Right, just constant, nonstop financial traffic.
Exactly. Now imagine trying to rip out and completely replace the foundational power grid of that entire city, like the very cables that keep the lights on, but doing it without letting a single light bulb flicker.
Which sounds completely impossible.
Right. But that is precisely the scale and, frankly, the stakes of what the Reserve Bank of India is executing right now. So today, we are taking you inside a financial network that's currently handling over 660 million transactions every single day.
It's just a staggering number when you say it out loud.
It really is. We're looking directly at the engine of the world's most dynamic economy, taking the hood off and analyzing how the financial gears are fundamentally rewiring themselves in real time.
And, the sheer operational physics of it are just staggering. When you're looking at the foundational architecture of an economy this size, it's incredibly easy to get lost.
Oh, for sure.
Yeah, you get lost in this dense forest of acronyms, policy mandates, percentages. You'd see the massive transaction volumes, you try to categorize them. But the broader geopolitical and, systemic context can easily just slip away from you.
Yeah, you miss the forest for the trees.
Exactly. So our goal for you today, whether you're preparing for a critical regulatory briefing or maybe working deep in the fintech sector, or even if you're just trying to understand the invisible forces shaping your digital wallet, is to anchor these developments.
Anchor them into a coherent framework.
Right, a logical framework. We aren't just going to tell you what the RBI did in the 2025-26 period. We're going to unpack the underlying structural logic of why they had to do it.
And the source material for our deep dive today is really the definitive blueprint for this transformation. We're looking exclusively at Chapter 9 of the Reserve Bank of India's annual report for 2025-26, specifically the section targeting payment and settlement systems and information technology.
It is a dense read, but so crucial.
Absolutely. So we're going to explore the explosive divergence in digital payment trends. We'll dissect the new strategic rulebook, which is Payments Vision 2028.
Right.
We're going to look at why a network doing billions of digital pings is simultaneously overhauling its paper check clearing system. Why bother? Right.
It seems counterintuitive, but there's a huge reason for it.
We'll get into that. We'll also cover how India is actively exporting its digital infrastructure to the rest of the world. And finally, the colossal IT backbone being built to support it all.
Including a highly sophisticated sovereign cloud.
Yes, and a radical move to secure the internet at the DNS level. So a lot of ground to cover.
It's a massive undertaking, but the thing to keep in mind is that every single piece is deeply interlocked.
How so?
Well, you can't fully comprehend the urgency behind building a bespoke sovereign cloud without first understanding the transaction velocity of the Unified Payments Interface, or UPI.
Right. The speed dictates the need for the infrastructure.
Exactly. And you certainly cannot understand the RBI's new, seemingly counterintuitive protocols regarding payment friction without grasping the sheer speed at which modern settlement systems now operate.
Okay, so let's start right at the foundation with the macro picture. Because before we can debate the merits of specific technologies or, policy shifts, we really have to wrap our heads around the mind-bending scale of this ecosystem.
The data from this period is wild.
It is. The 2025-26 data reveals something that actually made me pause. Cashless transactions, which the report defines as all digital and paper-based non-cash instruments, saw a massive 26.8% growth in volume over the year.
A huge jump.
Right. But the value of those transactions only grew by 13.2%. I want to pause on that divergence for a second. If the sheer number of transactions is growing twice as fast as the actual money changing hands, what is happening on the ground?
Well, that divergence is arguably the most critical analytical entry point into this entire report. When volume outpaces value by a factor of 2, it signals a fundamental sociological shift in how money is perceived and used.
A sociological shift.
Yeah. Historically, digital transactions were the domain of the bank elite. Use an electronic transfer to buy a car, pay a massive vendor, or settle a real estate transaction. High value, low volume.
Right, you weren't swiping a card for a pack of gum.
Exactly. What a 26.8% volume growth paired with just a 13.2% value growth tells us is that digital payments have completely saturated the microeconomy.
So we aren't talking about buying cardios online anymore. We're talking about someone buying a single cup of tea at a roadside stall or paying 10 rupees for a shared auto rickshaw ride.
We call it the secutization of digital payments.
Secutization. I like that word.
It fits perfectly.
Yeah.
Just like consumer goods companies realized they could reach hundreds of millions of new customers by selling shampoo in tiny 1 rupee sachets rather than large bottles, the financial system has secutized money movement.
It's become a baseline utility.
Precisely. It is a baseline utility for the masses. The system is no longer a premium service. It is the default medium of exchange at the street level. But, and this is the catch, this creates an enormous infrastructural burden.
Because processing a 10 rupee transaction?
Requires the exact same number of server pings, cryptographic authentications, and ledger updates as processing a 10 million rupee transaction.
Wait, I have to challenge the economics of that. If the banking system is processing hundreds of millions of these tiny 10 rupee transactions, the compute costs, like the electricity, the server space, the bandwidth, it must be astronomical.
Oh, it is. It's a massive expense.
So if volume is doubling but the value isn't keeping pace, aren't the banks essentially losing money? Like they're subsidizing the infrastructure for millions of tiny transactions that yield practically no float or fee revenue.
You are hitting on a massive debate within the banking sector right now. On a purely transactional basis, processing a 10 rupee UPI payment does not generate direct revenue to cover its compute cost.
Especially given the zero merchant discount rate mandate for certain UPI transactions, right?
Exactly. The banks make nothing on the actual transfer. However, the banks and the regulator look at this through the lens of data and systemic liquidity.
Data as the new currency.
Right. By capturing every single microtransaction digitally, banks are building incredibly rich data profiles on hundreds of millions of citizens who were previously completely invisible to the formal credit system.
Ah, okay. So the tea vendor doing 50 10 rupee transactions a day is suddenly generating a verifiable cash flow history.
Correct. The bank might lose a fraction of a paisa on the compute cost of the transaction, but they can now offer that tea vendor a microloan based on verifiable digital cash flow rather than asking for physical collateral.
Wow. So the transaction itself isn't the product. The transaction is basically a customer acquisition tool for the broader credit ecosystem.
That is exactly how you have to look at it.
And the numbers backing up this secutization are almost hard to conceptualize. Let's look at the absolute titan of this space, which is UPI. In the 2025-26 period, UPI surpassed 241.6 billion in transaction volume.
It's an astronomical figure.
I had to read that twice. 241.6 billion, and the total value was 314.2 lakh crore rupees.
To put 241.6 billion transactions into a human perspective, you're looking at roughly 660 million transactions happening every single day.
Unbelievable.
Or to break it down further, about 7,600 transactions every second of every day, all year long.
Every single second.
Right. And this is why the divergence between volume and value dictates policy. When a system reaches a velocity of 7,600 transactions per second, it transitions from being a financial tool to being critical national infrastructure.
Because the stakes are so much higher.
Exactly. If a retail banking app goes down for 5 minutes, it's an inconvenience. If a network processing 660 million daily payments experiences 5-minute latency spike, it creates a cascading gridlock in the national economy.
People literally can't buy food, trucks can't pay tolls, supply chains just halt.
It becomes the circulatory system of the country.
And we can't ignore the heavy lifting happening in the background either. The Real-Time Gross Settlement System, RTGS, which handles the massive, large-value corporate and interbank transfers, also saw significant growth. We're talking 15.7% in volume and 12.9% in value.
It's going right alongside the retail sector.
Yeah, retail payments as a whole mirrored the broader cashless trend, hitting a 26.8% volume increase and a 14% value increase. All of this data really culminates in a very specific metric that the RBI uses to track this transformation, which is the Reserve Bank's Digital Payments Index, or the RBI DPI.
The RBI DPI is essentially the vital signs monitor for this entire macroeconomic shift. By September 2025, that index had climbed to 516.76.
Now, for the uninitiated, an index number in a vacuum doesn't mean much. What's the baseline for that 516.76 figure?
A baseline for the RBI DPI is March 2018, which is set at the score of 100.
Oh.
So when we see a score of 516.76 by late 2025, it objectively demonstrates that the depth, penetration, and performance of digital payments across the country has multiplied more than 5 times over in just about 7 years.
5 times over, that's rapid.
And it is a composite metric.
Yeah.
It doesn't just measure how many people have a banking app. It measures payment enablers like internet and mobile penetration.
Right.
It measures supply-side infrastructure like the number of point-of-sale machines and QR codes. It measures demand-side factors like fast tags for tolls. And critically, it measures consumer centricity, which tracks system declines and complaints.
So it's a completely holistic grade of the entire digital nervous system. But, you don't scale an index from 100 to 516 without a master plan. And you certainly don't manage a network doing 7,600 transactions a second without a very strict set of rules governing the chaos.
No, you absolutely have to have a robust governance framework.
Right. When you transition from a cash-heavy economy to one where daily interactions are overwhelmingly digital, the central bank has to fundamentally change its identity.
The role of the central bank evolves dramatically. It is no longer just a macroeconomic ivory tower printing currency and pulling the levers of inflation and interest rates.
So what does it become?
It essentially becomes the chief technology officer and the ultimate cybersecurity guardian of a massive digital public good.
And their operational playbook for this new reality is something called Payments Vision 2028, officially issued on March 27, 2026. Now, looking at past vision documents from the RBI, the tone was always about onboarding.
Getting people into the system.
Yeah, getting more bank accounts open, getting more merchants to stick QR codes on their counters. But Vision 2028 has a very different posture.
The posture has completely shifted from offense to defense, or more accurately, to consolidation and resilience.
That makes sense.
The core focus areas of Vision 2028 are user empowerment, fraud safeguards, cross-border payment efficiency, and the ease of doing business. The regulator has effectively declared that the access and growth phase, the battle to get the population digitized, is largely a solved problem.
They won that battle.
They did. The challenge now is that a system of this unprecedented size, carrying 314 lakh crore rupees on UPI alone, is a prime target for the most sophisticated organized cybercrime syndicates on the planet.
Let's get into the specifics of Vision 2028, because there are some proposals in here that radically alter how we interact with our money.
Yes, there are some major changes.
One of the measures they're pushing is a universal switch-on, switch-off facility for all digital payment modes. Now, we've seen localized versions of this, like opening your credit card app to temporarily block international transactions.
Right, that's pretty common now.
But applying a switch-off mandate universally across all payment types, I have to ask, doesn't that defeat the entire purpose of a frictionless 2047 digital economy? If I have to log into a portal, authenticate myself, and toggle a switch just to buy a coffee, haven't we just recreated banking hours?
It is a valid concern for sure, but you have to look at it through the lens of vulnerability profiling. The always-on nature of digital finance is incredible for a young, tech-savvy urban professional. But consider a vulnerable demographic.
Like an elderly citizen.
Exactly. Perhaps an elderly citizen in a semi-urban area.
Yeah.
They might only need to use digital payments twice a week when they physically visit the market to buy groceries.
Okay.
For the other 160 hours of the week, their account sits there, fully active, capable of transferring their entire life savings in milliseconds, acting as a massive attack surface for remote social engineering or phishing scams.
Ah, I see. So it's about reducing that attack surface.
Exactly. The switch-on, switch-off facility isn't about forcing friction on the power user. It is about providing an absolute system-level quarantine for the vulnerable user.
That's a great way to put it.
If that elderly citizen can toggle their UPI or a net banking completely off when they're sitting at home, it fundamentally neutralizes the threat of remote digital fraud during that time. It changes the dynamic from opting out of fraud to opting into transacting. It places ultimate physical control back in the hands of the consumer.
That reframes it completely. It's like a digital deadbolt.
Yes, a perfect analogy.
But Vision 2028 doesn't just put the onus on the consumer. In fact, it drops a massive hammer on the banks themselves with the proposal of a shared responsibility framework. The report explicitly states that moving forward, the customer's bank, the issuer, and the beneficiary's bank will jointly bear liability for fraud.
This is a seismic shift in banking regulation. To understand why this is so revolutionary, you have to understand the historical blame game of banking fraud.
How did it usually work?
Let's say a customer is tricked into sending money to a scammer. The customer complains to their bank, the issuing bank. The issuing bank looks at the logs and says, well, the money left our system securely. You authenticated the transaction with your PIN. Our systems weren't breached. It is not our fault.
And then the customer goes to the bank that actually received the money.
Right. And the receiving bank, the beneficiary bank, says, We just passively received a valid transfer into a registered account. We didn't initiate the fraud. It's not our problem.
Wow, so everyone points fingers.
Exactly. The result is that the consumer is left holding the bag, and neither bank has a strong financial incentive to aggressively police the network beyond their own walls.
So, by introducing a shared liability framework, the RBI is essentially tying both banks together.
It forces systemic cooperative security upgrades. If a scammer opens a mule account at Bank B to receive stolen funds, Bank B can no longer turn a blind eye and hide behind the excuse of being a passive receiver.
Because now they have skin in the game.
Under shared liability, Bank B will be financially penalized for allowing that mule account to exist on their ledger. This means Bank B is now forced to dramatically upgrade its Know Your Customer, or KYC, protocols and its real-time transaction monitoring.
It's like having bouncers at both the front door and the back door of a club. If someone sneaks in and causes damage, management docks the pay of both bouncers. Suddenly, those two bouncers are going to start communicating a lot better and checking IDs a lot more thoroughly.
That is the exact behavioral economics at play here. It aligns the financial incentives of the institutions with the security needs of the consumer.
Brilliant.
And Vision 2028 also introduces a Cyber Key Risk Indicators, or KRI, framework specifically targeted at non-bank payment system operators.
Because the ecosystem isn't just traditional banks anymore, right?
Right. It's fintechs, payment aggregators, wallet providers. The KRI framework establishes a standardized, quantifiable baseline for cyber resilience across all these disparate entities.
There is another mandate in Vision 2028 that really caught my attention, which is the push for interoperability in TREDS. That's TREDS, which stands for the Trade Receivables Discounting System. We throw this acronym around, but what is the actual mechanical problem this solves, and why does making it interoperable matter?
TREDS is one of the most vital yet under-discussed pieces of financial infrastructure for the broader economy. To understand it, we need a real-world scenario.
Okay, set the scene.
Imagine a small textile manufacturer in Surat. They get a massive order from a giant multinational retail corporation. The manufacturer spends all their capital buying raw materials, paying workers, and shipping the textiles.
And then they issue an invoice to the massive retailer.
Yes, but the giant retailer dictates the terms, and they might say, we will pay this invoice in 90 days.
Oh,
Right. Now, our small manufacturer in Surat is out of cash. They can't pay their workers for the next 3 months because all their capital is locked up in that unpaid invoice. This cash flow crunch is what kills micro, small, and medium enterprises, or MSMEs.
so how does TRED step in to fix that?
TREDS is a digital platform where that small manufacturer can upload that verified invoice. Banks and financial institutions on the platform see the invoice, they see that it is backed by the creditworthiness of the giant retail corporation, and they essentially did to discount the invoice.
So they offer cash up front.
Exactly. A bank might offer the manufacturer 98% of the cash right now, immediately, and then the bank collects the full 100% from the retailer in 90 days. It unlocks working capital instantly.
That is brilliant. It literally turns an IOU into immediate liquid cash. But why the mandate for interoperability?
Because currently, there are multiple TREDS platforms. If our manufacturer is registered on Platform A, they only get bids from the banks on Platform A.
Which limits competition.
Exactly. By mandating interoperability, Vision 2028 aims to link all these platforms together. It means our manufacturer in Surat uploads their invoice once, and every single participating bank across all platforms can bid on it.
Oh, wow.
It creates a unified, highly competitive national market for invoice discounting, ensuring the MSME gets the lowest possible interest rate.
It truly democratizes liquidity. That's an incredibly powerful tool. But executing this level of sophisticated systemic regulation, from shared fraud liability to interoperable invoice discounting, it requires a very specialized governing body.
And that brings us to a major governance milestone documented in the report. The very first meeting of the Payment Regulatory Board, the PRB, took place on January 5, 2026.
And the person they put at the helm of this, Governor Sanjay Malhotra, is holding arguably one of the most high-stakes steering wheels in the country right now. His mandate at the Payment Regulatory Board isn't just administrative, it's about national economic security.
The activation of the PRB, under Governor Sanjay Malhotra, is the institutionalization of the RBI's oversight.
Why do they need a separate board, though?
Because managing monetary policy, deciding whether to raise or lower interest rates to fight inflation, requires a completely different skill set and operational tempo than managing a 7,600 ping per second server architecture.
That makes total sense.
Payments have grown so massive that they rival the money supply itself in systemic importance. The PRB ensures there is a dedicated statutory body looking exclusively at the nuances, threats, and architectural needs of the digital payment grids.
Speaking of architectural needs, I want to pivot a bit because as I read further into Vision 2028, I hit a section that genuinely baffled me.
Oh, which part?
Well, amidst all this talk of AI, interoperability, and billions of digital pings, the RBI mentions exploring electronic checks. I have to ask why. In a world where UPI is doing 241 billion transactions, and we are debating the nuances of switch-on, switch-off digital facilities, why on earth are we spending regulatory energy digitizing checks?
It does seem archaic.
Right. Isn't that like trying to bolt a jet engine onto a horse-drawn carriage?
I completely understand the instinct to view checks as an anachronism, but this highlights a fascinating divide between retail convenience and the rigid mechanics of corporate law.
Corporate law?
Yes. We love the instantaneous speed of digital payments for retail, but checks still play a foundational structural role in complex business-to-business transactions, escrow arrangements, and, most importantly, the legal system.
How so? I mean, a digital transfer leaves a perfectly clear audit trail.
An audit trail, yes, but not necessarily a specific legal contract of liability. When a business issues a post-dated check, it isn't just scheduling a payment, it is issuing a highly specific legal instrument.
Okay, I'm following.
Under Section 138 of the Negotiable Instruments Act in India, a bounced check carries specific, well-established legal weight, including criminal liability and the potential for imprisonment. A failed digital transfer or a reversed direct debit simply does not seamlessly replicate that exact same threat matrix in court law.
Ah, so it's less about the physical movement of the money and entirely about the legal contract that the piece of paper actually represents.
Precisely. The courts have decades of established precedent for handling a bounced check. If the RBI were to simply turn off the check infrastructure tomorrow, they would fracture complex corporate supply chains, void millions of post-dated credit agreements, and throw the legal system into chaos.
That would be a disaster.
So the regulator's approach is pragmatic. They cannot turn the system off, so they must upgrade the plumbing to make the legacy system move at the speed of the digital systems.
And that is the perfect segue into our next focus area, which is upgrading the plumbing. Answering the question of why we still care about checks leads directly to how the RBI is physically overhauling these legacy networks.
It's a massive physical overhaul.
Let's look at the check truncation system, the CTS. According to the report, it underwent a massive upgrade, with Phase 1 going live on October 4, 2025.
The operative phrase to focus on here is a transition to continuous clearing and settlement on realization.
Right.
To appreciate the magnitude of this upgrade, you have to look at how check clearing operated for decades. It was based on a batch processing model, commonly referred to as T+1.
Meaning trade plus 1 day.
Exactly. You deposit a check at your branch on Monday. That physical check, or its scanned image under the older truncation system, goes into a massive digital holding pen. It sits there all day.
Just waiting.
Overnight, the central clearinghouse runs a massive batch process, settling accounts between all the different banks simultaneously. If everything clears, you get your money on Tuesday, or sometimes even Wednesday.
But the new mandate fundamentally alters the physics of this process. The RBI has ordered a shift to continuous processing during presentation and confirmation sessions. And the mandate given to the banks is incredibly aggressive. They are now required to credit customer accounts within 1 hour of settlement. 1 hour.
Revolutionary for the corporate sector.
And dishonored checks are instantly filtered out and returned.
The macroeconomic impact of shrinking that timeline is staggering. Think about the concept of float. Funds that have been debited from the payer's account, but have not yet been credited to the payee's account.
Right.
In a T+1 system, there are billions of rupees trapped in the ether of the clearinghouse every single night.
It's money that essentially doesn't exist for 24 hours. Nobody can use it.
Right. By shrinking the clearing time from 24 hours down to a maximum of 1 hour, you are unlocking billions of rupees in working capital for the economy on a daily basis.
That's huge.
The manufacturer gets their funds 23 hours faster. They can buy inventory faster, pay their logistics provider faster, and reinvest capital faster. It dramatically increases the velocity of money without the central bank needing to actually print more money. It is a massive efficiency multiplier.
That is a phenomenal way to frame it. Upgrading the pipes isn't just about speed, it's about increasing the pressure and volume of the entire economic engine.
Exactly.
But the physical plumbing upgrade extends far beyond just the speed of settlement. It's also about the depth and quality of the data moving through those pipes. The report highlights a massive migration to something called the ISO 2022 standard. Specifically, the National Electronic Funds Transfer System, NEFT, is now fully compliant, and over 230 member banks have migrated their core banking solutions to this standard.
ISO 2022 is often referred to as the Rosetta Stone of modern global finance.
That's a big claim.
Well, the legacy messaging systems that the banks used to talk to each other, like the older MT message formats, they were incredibly rudimentary.
Give me a sense of how rudimentary we're talking.
Think of it like a very basic, character-limited telegram. The data fields were rigid and small. You could basically transmit account A at Bank X sends 100 rupees to account B at Bank Y.
Pretty bare bones.
The problem is that modern global finance requires massive amounts of compliance data to accompany every transaction. Anti-money laundering or AML checks, sanctions screening, ultimate beneficial owner declarations, purpose codes for cross-border trades.
And those old telegrams just couldn't fit at all.
Because the old system had limited character fields, if a corporate name was too long, it literally just got truncated.
And when a name gets truncated, I assume a compliance algorithm flags it as suspicious because it can't match it to a known entity.
Exactly. It triggers a false positive. The transaction gets frozen, and a human compliance officer has to manually review it, call the sending bank, and figure out what the truncated data was actually supposed to say.
Wow, so it creates massive friction and delays.
Huge delays.
So, if the old MT format is a character-limited telegram, moving to ISO 2022 is basically like upgrading to a rich text messaging app. You aren't just sending the money, you're sending a massive, structured dossier of data along with it. Location data, read receipts, unlimited character fields, high-res attachments of compliance forms.
That is the perfect analogy. ISO 2022 uses a flexible XML format. It has distinct, unlimited, structurally standardized tags for every conceivable piece of financial metadata.
So it's incredibly organized.
Yes, it clearly delineates the ultimate debtor from the ultimate creditor. Because the data is structured so granularly, it doesn't need external software converters to be understood by different banks, whether domestically or internationally.
And I imagine this makes automated compliance much more viable.
That is the ultimate goal. Direct, end-to-end transmission of ISO messages allows artificial intelligence and automated compliance systems to instantly read the metadata of a transaction.
So no more false positives because of cutoff names.
Right. If a transaction trips a compliance wire, the system knows exactly why, who the ultimate beneficial owner is, and what the precise purpose of the trade was, all without requiring human intervention. It streamlines global trade significantly.
Which is an amazing technical capability. But it brings us to a much darker reality and straight into our next focus area: fighting friction and fraud.
A constant battle.
Yeah, moving money faster through continuous clearing and making it instantly readable with ISO 2022 is incredible for the economy. But speed is an unbiased double-edged sword. If legitimate money can settle in 1 hour instead of 24 or in milliseconds via UPI, it means stolen money can be moved, layered, and extracted out of reach just as fast.
This is the core architectural tension in all modern payment systems. For the last 10 years, the entire fintech industry has been obsessed with optimizing for zero friction. One-click checkouts, instant biometric authentication, invisible payments.
Because consumers love it.
They do. But we have learned a hard lesson. When the system is frictionless for the consumer, it is also perfectly frictionless for the fraudster.
And to combat this accelerated threat environment, the RBI established the Digital Payment Intelligence Platform, the DPIP. Looking at the timeline in the report, Phase 1 of the DPIP prototype, which they titled the Smart Registry, went live in August 2025. What exactly is a smart registry?
The Smart Registry is the foundational layer of intelligence sharing. Historically, banks fought fraud in complete silos.
Meaning they didn't talk to each other.
Right. If a fraudster set up a network of mule accounts at Bank A, and Bank A finally caught on and shut them down, the fraudster would just walk over to Bank B and set up the exact same network. Bank B had no idea what had just happened at Bank A.
That's incredibly inefficient.
The DPIP aims to pool this intelligence across the entire sector in real time. If a specific device ID, IP address, or account pattern is flagged at one institution, the Smart Registry ensures every other institution on the network knows about it instantly, preventing funds from being routed there.
Okay, so it completely breaks down the silos, and they are bringing out the heavy artillery for Phase 2. The report notes that Phase 2 involves leveraging advanced tech, artificial intelligence and machine learning to build an AI risk scoring platform capable of identifying suspicious transactions in real time.
It's a massive technological leap.
But as I was reading this section, I hit a paragraph that genuinely surprised me. Despite all this advanced AI, the RBI is actively exploring the deliberate introduction of frictions in digital payment processes to combat what they define as authorized push payment frauds.
What's fascinating here is the psychology behind authorized push payment fraud, or APP fraud. This isn't a scenario where a sophisticated hacker uses a brute force algorithm to break into a bank's mainframe.
So the technology is secure.
The technology is completely secure. The vulnerability in an APP fraud is the human being.
Right, this is a social engineering attack. So a fraudster tricks a customer, maybe through a fake phone call pretending to be from the tax department, or a phishing link claiming their electricity is about to be cut off, or even a sophisticated investment scam.
Exactly. The fraudster creates a profound sense of panic or urgency, and the victim willingly opens their banking app, enters their highly secure PIN, and hits send. The customer is authorizing and pushing the payment.
And from the bank's perspective, the system worked perfectly.
Yes.
The cryptography held up, the biometric authentication was valid, the bank server just thinks, well, the customer entered their correct PN, they clearly want to send this money.
Precisely. You have a situation where the technology is flawless, but the outcome is catastrophic. And how do you patch a human vulnerability? You cannot just write better code. You have to deliberately reintroduce friction into the user experience.
To break the panic cycle.
Yes. The RBI is recognizing that in our rush to make payments instantaneous, we stripped away the time a human being needs to realize they are actually being scammed.
But reintroducing friction sounds like a terrible PR move for a central bank that just spent a decade boasting about how fast their systems are. I mean, we just discussed how they mandated 1-hour check clearing to speed things up. Now they want to slow things down.
It is a delicate balance.
How do they balance adding friction, like extra authentication steps, mandatory cooling off periods for new payees, or that kill switch we discussed earlier, without ruining the baseline convenience that made systems like UPI so universally popular?
That is the exact tightrope the regulator is walking, and it is where the AI risk scoring in DPIP Phase 2 becomes the critical balancing mechanism. The goal is not static friction. The goal is dynamic friction.
Dynamic friction.
Yes. Instead of adding a mandatory 5-minute delay to every single transaction, the AI will evaluate the context of the transaction in milliseconds.
Give me an example of how the AI differentiates.
Well, if you are buying coffee at the shop you visit every Tuesday morning at 8 a.m., the AI risk score is incredibly low, 0 friction. The payment goes through in milliseconds.
Normal routine.
Right. But if you suddenly try to transfer 50,000 rupees to a newly created account in another state at 2 p.m. from a device that hasn't been used before,
the AI flags a massive anomaly.
Exactly. And then the system dynamically introduces friction. It might pause the settlement for 2 hours. It might ask for secondary biometric verification. It might even trigger an automated phone call to the account holder asking them to verbally confirm the intent.
It's precision-guided security. It only slows you down when you're about to drive off a cliff.
That's a great way to think about it.
And a system that is lightning fast for legitimate transactions, heavily standardized with ISO 2022 data, and highly secure with AI-driven dynamic friction. Well, that is an architecture that is inherently valuable on the world stage, which brings us to the geopolitical maneuvers detailed in the report, taking India global.
The international expansion of India's digital payments infrastructure is not just a technology story. It is one of the most significant economic diplomacy narratives of this entire decade. The focus has firmly shifted outward.
The geographic spread detailed in the 2025-26 report is highly testable material, so let's map it out. UPI is officially no longer just a domestic phenomenon. The Fast Payment System, or FPS linkage, with Singapore's Pay Now is fully operational.
Yes, that's a huge milestone.
Beyond that, QR code merchant acceptance for UPI has expanded significantly. We are looking at active deployments in Bhutan, France, Mauritius, Nepal, Qatar, Singapore, Sri Lanka, and the UAE.
It is vital to distinguish between the two different modalities of international expansion happening here.
Okay, let's break them down.
The linkage with Singapore's Pay Now is an infrastructure bridge. It allows for cross-border personal remittances. This means an Indian worker residing in Singapore can send money instantly to their family's bank account in India 2047 at a fraction of the cost of traditional wire services like Western Union or SWIFT transfers.
So it bypasses the old, slow networks.
It directly attacks the high friction and high fees of the global remittance market.
And what about the QR code acceptance in places like France or the UAE?
That is a different mechanism entirely. That is about consumer convenience in bypassing Western payment networks. It enables an Indian tourist in Paris to walk up to a merchant, scan a QR code, and use their domestic UPI app to pay for a croissant.
So they don't even need to exchange currency or use a credit card.
Exactly. The transaction is settled directly between the Indian and French banking systems, completely bypassing traditional Forex cards, Visa, or MasterCard networks. It keeps the transaction routing and the data sovereign.
But the ambition documented in the report goes way beyond just letting tourists buy pastries with their phones. It details that actual UPI-like infrastructure is being actively deployed in nations like Namibia and Peru. Furthermore, the RuPay stack deployment for domestic card schemes has been completed in Mauritius and the UAE. The driving force behind all this global engineering is NIPL, NPCI International Payments Limited.
If we evaluate this strategically, exporting the core architecture to Namibia and Peru is a profound geopolitical move. For decades, the global financial rails were dominated by a handful of Western tech giants and the SWIFT messaging network.
Which gives them huge power.
Immense geopolitical leverage. By exporting the UPI and RuPay tech stacks to emerging markets in South America and Africa, India is actively establishing its digital public infrastructure, its DPI, as a viable, sovereign, global benchmark.
It sounds like digital diplomacy. We aren't just exporting physical goods or software services, we're exporting the actual roads that the global digital economy will travel on.
That is exactly what it is. When a country like Namibia adopts a UPI-like system built on Indian architecture, it fundamentally de-risks their economy from reliance on Western payment gateways. It provides them with a sovereign, low-cost, highly efficient alternative.
And what's the benefit back home?
For India, the benefits are massive. It deepens bilateral economic ties, it creates massive interoperable markets for Indian businesses, and it positions Indian technological standards at the very heart of the emerging market financial architecture.
But let's pause and consider the sheer infrastructural weight of all this. To support a domestic system handling 660 million transactions a day while simultaneously running continuous one-hour check clearing, integrating with Singapore's PayNow, and exporting core infrastructure to South America and Africa, the Reserve Bank's own internal servers must be virtually invincible.
They have to be. There's no room for error.
Which brings us to the most technical but arguably most crucial part of the report, the IT backbone.
Right, because every single innovation we've discussed, the AI risk scoring, the continuous settlement, the cross-border linkages, is ultimately just software running on a server somewhere.
Yeah.
If the core banking solution of the central bank fails, the entire national economy halts. For the Reserve Bank of India, that foundational core banking solution is called eKuber.
The 2025-26 report outlines the transition to eKuber 3.0, the next-generation core banking architecture. They detail the phased development and migration of critical modules for government accounts, primary auctions, public debt management, and the central accounts section.
It's a massive software upgrade.
But while upgrading the core software is vital, the piece of IT infrastructure that truly signifies a paradigm shift is the creation of the Indian Financial Sector Cloud, or the IFS Cloud.
The IFS Cloud is a monumental undertaking in sovereign engineering. The report notes that Phase I Beta is already live with 9 initial entities onboarded.
Right.
It is offering fundamental enterprise-grade capabilities, and it lists out a massive alphabet soup of services. Infrastructure as a service, IaaS, Platform as a Service, POS, Software as a Service, SaaS, Container as a Service, CoAS, Storage as a Service, STaaS, and Public Internet Protocol, IPOs.
That is a lot of acronyms.
And Phase 2 is already in the pipeline, promising advanced features like API management and DevSecOps.
Okay, I have to push back hard on this initiative, though. Building a cloud from scratch is incredibly, almost punishingly resource-intensive.
Oh, without a doubt.
It requires massive physical data centers, complex virtualization layers, immense cooling infrastructure, and armies of engineers just for ongoing maintenance. Amazon Web Services, Google Cloud, and Microsoft Azure spend billions of dollars a year on R&D to perfect these technologies.
True.
Why on earth is the RBI going through the trouble of building out all these as-a-service modules when massive, highly secure commercial clouds already exist? Why is the central bank trying to reinvent the wheel?
It is the most common critique of the project, absolutely. But the answer comes down to three absolute imperatives for a sovereign nation: data localization, specialized governance, and absolute systemic resilience.
Okay, break that down for me.
You are correct that commercial tech giants are incredibly capable. However, they operate on global multi-tenant architectures, their servers are shared, their data is often distributed across multiple geographic nodes, and ultimately they are subject to foreign jurisdictions and foreign corporate boards.
Let me make sure I understand the risk here. You're saying that if the RBI manages the public debt of India on a commercial cloud, they're inherently vulnerable to external shocks.
Precisely. When you are the Reserve Bank, managing the settlement of the entire financial sector and holding the national debt ledger, placing that data on servers owned by a foreign corporation, presents an unacceptable systemic vulnerability.
What's the worst-case scenario?
What happens if there's a geopolitical conflict and a global sanctions regime is enacted? What happens if that commercial provider experiences a massive global IT outage due to a bad software update, which we have literally seen paralyze airlines and hospitals globally?
Yeah, we've definitely seen that happen.
The Indian financial system cannot afford to be collateral damage to a tech company's deployment error or a foreign government's sanction policy.
I get it now. So it is entirely about building a digital fortress.
Exactly. By building the bespoke IFS cloud, the RBI achieves true, unquestionable data localization. The data physically resides within Indian borders, on hardware controlled by Indian entities, subject exclusively to Indian law.
That makes total sense.
Furthermore, the governance models of AWS or Azure are designed to accommodate generic enterprise clients, everyone from a startup selling shoes to a massive media streaming service. The IFS cloud is bespoke.
Purpose-built.
Right. Its security protocols, latency optimizations, and compliance frameworks are tailored specifically and exclusively for the rigorous, high-stakes environment of central banking and financial market infrastructures.
Let's unpack some of those acronyms to understand the capability of this fortress. They mention Container as a Service, or PaaS. Why does a central bank need CaaS?
Think of a container like a perfectly sealed digital sandbox.
Yeah.
If the RBI wants to test a highly experimental new feature for the digital rupee, they don't want to run that test on the live production servers, where a crash could take down the entire banking grid.
Right, that would be catastrophic.
Container as a service allows them to wrap that experimental application in a secure, isolated bubble. If the application crashes or if it has a vulnerability, it is entirely contained within that sandbox. It gives the central bank the ability to innovate and test at the speed of a tech startup without risking the stability of a 100-year-old institution.
It's basically risk-free innovation. The report also notes the ongoing development of the Alternate Payment System, or APS, and the Global SFMS Hub, which acts as a cross-border messaging system built on that data-rich ISO 2022 standard we discussed earlier.
It all ties back together perfectly.
It does. They're building an end-to-end, sovereign, secure pipeline. But as we move into our final focus area today, securing the ecosystem, we encounter a very sobering reality.
Yes, this is where the macro truly meets the micro.
Exactly, because you can have the most sovereign, bespoke IFS cloud in the world. You can have eKuber 3.0 running flawlessly, settling millions of continuous check clearances. You can have the smartest AI in the DPIP analyzing transactions.
And none of it matters if the user is compromised.
Right. If a consumer receives a text message, panics, clicks a fake link, and enters their credentials on a website that looks exactly like their bank, all of that multi-billion-dollar infrastructure is bypassed in a second.
The human element is always the weakest link in any cybersecurity chain.
We talked earlier about adding friction to stop push payment fraud, but the RBI executed another move in 2025-26 that I can only describe as a masterstroke. They addressed the vulnerability not at the banking level, but at the foundational architecture of the internet itself, the DNS level.
Let's look at the facts of the mandate. India became the very first country globally to mandate an exclusive secure internet domain exclusively for its banking system, the .bank.in domain.
This simply cannot be overstated in its importance. The migration process was heavily enforced by the RBI. The deadline was strict, October 31st, 2025. By that date, all public sector banks, private sector banks, small finance banks, payment banks, regional rural banks, and local area banks had successfully migrated their digital presence.
Everything, their websites, their portals, their customer-facing interfaces to this new domain.
And the global central banking community took immediate notice of this structural fix. The report proudly highlights that this initiative won the prestigious Initiative of the Year 2026 award from Central Banking in London, UK.
A huge international recognition.
And they aren't stopping with just the banks. There's already a stated future plan to extend this concept with the .fin.in domain for non-bank entities, like mutual funds or insurance providers, in the broader financial sector.
But let's break down the actual mechanics for the listener. How does a simple change to the end of a URL structurally neutralize fraud?
Yeah, how does that work?
To understand the brilliance of this, you have to understand the cognitive burden of trust on the internet. In the past, banks used standard .com or .in or .co.in domains. The architectural flaw is that anyone in the world with a credit card can register a .com domain.
Anyone at all.
Exactly. A fraudster operating out of another country could register a domain like, say, hdfcbanks-customersupport.com for $10. They clone the bank's website design perfectly and blast out millions of phishing SMS messages.
And the average user looking at that link on a small smartphone screen in a state of panic because the text message said their account was blocked isn't going to notice that the URL has an extra "es" or a hyphen in it.
Exactly. The burden of verification was placed entirely on the consumer. The bank's only defense was to constantly run education campaigns telling millions of people to look out for slight typos or check for the padlock icon.
Which fraudsters easily mimic anyway.
Exactly. So instead of trying to educate a billion people on the nuances of URL structures and SSL certificates, the RBI just moved all the legitimate banks into a highly guarded, digitally gated community.
Just cordon them off.
Yes. If the URL doesn't end in exactly .bank.in, it is simply structurally not a bank.
That is the elegance of the solution. The .bank.in domain registry is heavily restricted and overseen by the Institute for Development and Research in Banking Technology, or IDRBT. A fraudster simply cannot purchase a .bank.in domain regardless of how much money they have. They are locked out at the DNS registry level.
So the visceral panic a user feels when they click a suspicious link is instantly cured just by glancing at the URL bar. It is a systemic solution to a chaotic human problem.
They removed the cognitive burden from the end consumer and then placed it on the underlying architecture of the internet itself.
It perfectly encapsulates the theme of the entire 2025-26 report, moving from individual responsibility to systemic structural resilience.
And that theme is really the perfect note to begin wrapping up this deep dive. We have covered a massive amount of ground today, transitioning from the raw scale of the economy to the microscopic data fields of international trade. Let's do a rapid-fire summary to synthesize the core architectural shifts we've explored.
Sounds good.
We started with the mind-bending scale of the macro picture, UPI crossing 241.6 billion in transaction volume, driving the REI DPI index to a staggering 516.76. We explored how the divergence between volume and value proves that microtransactions are the new lifeblood of the formal economy.
Right. And from there, we unpacked the strategic goals laid out in Payments Vision 2028. Led by the newly activated Payment Regulatory Board and Governor Sanjay Malhotra, we saw a distinct pivot from purely driving growth to enforcing security.
We analyzed the shared liability framework that forces banks to cooperate, the protective capabilities of the switch-on, switch-off feature, and the mandate for interoperable triad-S platforms to unlock cash flow for small businesses.
Then we dove into the physical upgrades of the legacy systems, specifically the check truncation system. We looked at why checks still exist due to corporate law and how the shift from T+1 batch processing to continuous one-hour clearing unlocks billions in daily working capital.
We also decoded ISO 2022, understanding how upgrading from rudimentary Telegram messages to structured, data-rich XML dossiers streamlines global automated compliance.
We discussed the complex battle against authorized push payment fraud. We examined how the AI-driven digital payment intelligence platform, specifically the Smart Registry and AI risk scoring modules, aims to introduce dynamic, precision-guided friction to protect human vulnerabilities without destroying network convenience.
And we tracked the aggressive global expansion of Indian digital public infrastructure, from reducing remittance friction with Singapore's PayNow to deploying sovereign RuPay and UPI stacks in strategic emerging markets like Namibia and Peru, led by NIPL.
Finally, we looked under the hood at the colossal IT upgrades ensuring absolute financial sovereignty. The migration to eCuber 3.0, the highly secure, localized, bespoke IFS cloud providing critical as-a-service modules, and the globally recognized .bank.in domain that secures the entire ecosystem at the consumer level by neutralizing DNS-level phishing.
For you, the listener, the ultimate takeaway is the realization of your active participation in this ecosystem. Whether you are memorizing these frameworks for a regulatory exam, architecting solutions in a fintech startup, or simply using your smartphone to buy a cup of tea, you are interacting with the most rapid and comprehensive financial digitization event in human history.
The Reserve Bank of India has evolved way beyond its traditional mandate. It is operating as a premier technology powerhouse, managing a digital public infrastructure of unprecedented scale, speed, and complexity.
Taking the hood off that engine while the car is hurtling down the highway is intimidating, but it is undeniably an incredible feat of systemic engineering. And as we close, I want to leave you with a final thought to mull over, a projection that builds on everything we've decoded today.
What's the thought?
Well, we have spent this entire hour discussing how the RBI is building the DPIP to use AI for real-time risk scoring, and how money is increasingly becoming nothing more than structured, highly granular data residing on the sovereign IFS cloud. We see the trajectory clearly. Looking past 2026, if money is entirely digital, perfectly readable by machines via ISO 2022, and systems are fully interoperable, how long until artificial intelligence stops merely monitoring our transactions for fraud and begins actively, autonomously managing our financial lives?
Oh, wow.
If the data is there, how long until an AI agent is routing a small business's working capital across interoperable platforms, optimizing personal investments, and executing our daily payments completely in the background without us ever pushing a button?
When the friction is entirely removed from the intelligence layer, autonomous finance isn't just science fiction, it is the inevitable next step on the roadmap.
It is a profound and slightly terrifying frontier to consider. Thank you for joining us on this deep dive into the architecture of tomorrow's economy. Keep questioning the systems around you, keep analyzing the data, and keep diving deep.